Gold buys everything else. We'll develop it further. Okay, so the point is that if there's no one who's willing to take delivery of the gold, i.e. exchange their futures for the underlying, okay, then the temptation is to make the length of this much longer than anything that's written, any futures contract that is written. Okay, so what do we have here? Okay, what we've described here is basically the gold market equivalent of borrowing short and lending long, as it were. Okay, because you really only have the gold for 6 months, but you're lending it out for a period much greater than 6 months. Much, much greater than 6 months. Because you can. Is 6 months. Sorry, his liability is much greater. So he's lent the gold out for a much greater period than any of the futures contracts that he's written, basically. And he's happy doing that because he assumes that futures contracts are going to get rolled for the difference in the interim and not be called for the gold underneath. Is that clear to everyone?
Just.
Okay. No, I see a few heads nodding, so I can continue. I have to finish up quite soon because this is meant to be half a lecture. So when will this problem start to unravel? Okay, you've got mismatching maturities here. When will this problem start to unravel? Well, basically when the holders of gold futures want delivery of their gold. And if the rate at which they want delivery of their gold is higher than the rate at which gold is being received from leases, okay, then you have a problem, basically, and you move into backwardation. So cash gold is higher than spot gold is higher than cash gold.
So what's the difference?
Between spot gold, spot gold is higher than future gold. Okay? And this is nothing more than a symptom of what's been going on here. Okay? So when the maturity of the underlying collateral loans is in excess of the futures contract written, you will have problems with scientific fact at some point. There's no way you can get around it. So ultimately, from this basis, you can see that, alright, if push comes to shove and there's no gold come 6 months, you might be offered either cash settlement, or if you're particularly important, you might be offered the gold lease underneath it. But this is for sure, you will not get your gold. You will get your gold, but not when you want it. Now that to me is equivalently the same as not being able to get your gold. You're not able to exchange fiat for gold, or you won't be as a consequence of this for some point.
It's a default of a contract, essentially.
Yeah. Okay. I wrote this in December 2011, which was before Germany wanted their gold back. Okay, but basically when they wanted their gold back there and then, and the US government turned around and said, you can have your gold back, but over 7 years. So it's exactly what I've said here. You will get your gold, but not when you want it. Okay, And it's all because of the consequence of this. Okay, so backwardation signifies that people are not willing to hold a fiat claim or a fiat denominated claim to gold over the gold itself, basically. They can't be bribed by this difference. Anyone that has cash gold is being offered this premium to get rid of their cash gold in favour of the future. So normally, if we bring the analogy back to the apple market, okay, if someone has apples, they would take this. There's no reason for them not to. Okay, but they're not taking it. The backwardation in the gold is staying there. Even though anyone that has cash gold can sell at a premium, buy at a discount in the future, pocket the difference, and theoretically exchange that difference for gold and earn a gold return.
Essentially, saying the demand for gold right here and now is so high that everybody's bidding it up to the point where no one's so interested in getting it in the future because they don't believe that if they bought a futures contract they'd actually receive the metal.
There is an element of that to it, yeah, but it's more to do with the interplay of interest rates here, because I haven't talked about it. That's the subject of Professor's talk. But you've got the gold interest rate here, and you've got the fiat interest rate. You know, so what the competition turns into is a competition between fiat interest rates and gold interest rates. Now, normally fiat interest rates have to be much higher than gold interest rates for you not to want to have gold, as it were, on loan. Okay, you need that bribe. So as a consequence of that, the market is normally in contango. The price of the future is higher than the price of the spot. Okay, but now you've got a conundrum, okay, because fiat interest rates are heading one way only, basically, and gold interest rates can follow them, but only up to a point. And then the difference between fiat and gold and the problem with this arbitrage will become very apparent. Okay, is that you will not be able to exchange your dollar profit for gold at the end, or you won't be getting your gold back at the end when you expect it. Okay, so that's all the backwardation in gold is saying. Well, not that all, it's pretty major, you know. It's signifying that people are not willing to hold fiat over gold, even for comparatively short periods of time. I'm not just talking any people here, I'm talking about the people that matter in terms of gold supply. Okay, they're not willing to be bribed by this difference, or this difference is not sufficient for them to not have their gold for that time period. The difference might become sufficient, and they might be fooled away into doing it, but that's another matter.
To get a little bit of perspective, do you have any idea as to what the backwardation is for, say, 1 month or 3 months in the gold price?
I do. It's we've got charts of that later on.
Okay, sure.
It's about 0.03% for December at the moment. And if you compare what that figure was sort of this time last year, it was about -0.5%. You know, and before that, the year before, it was -0.5% as well. So this is what we're about to experience now. It's basically the competition between interest rates, fiat interest rates, and gold interest rates. And anything that's been done devious manner here is going to be exposed because of that, because of what is being done on the fiat interest rate market, or the fiat bond market, basically. Whatever has been done that's not above board in terms of matching your maturities will be exposed as fiat interest rates fall. Okay? And at some point, I'm not saying that everyone will not be willing to take this bribe. There will be some people who will be willing to take this bribe because they can't see the difference between owning gold, owning an ounce of gold, and owning the equivalent of that in dollars. They see no difference between the two. And if there are people that see no difference between the two, then there are people who will take this arbitrage. Okay? It's only when problems start to become more apparent that you will see less and less people willing to take this arbitrage. And this backwardation which has been coming out, in and out, gold has only been out of backwardation this year for about 10 days so far. You know, so it's becoming more, sorry?
And we're October.
And we're in October, exactly. So this is happening. This is a very quick and short explanation as to what backwardation in gold means. And now we're going to move to Professor to talk further about GOFO and falling gold prices.
Sandy, I was going to sing your praise, but you deprived me of the time.
Oh.
But anyhow...
Oh, okay.
I'll try to do my best. I'm not going to talk about GOFO. You are going to talk about later, because it's pretty technical. But let's just say I'm going to talk about the two-tier gold backwardation. And tier is spelled T-I-E-R. It's like a pillar. Now the word two-tier came into use way back in 20th century, 1968 to be sure, which was the year when the US ran out of gold, but it still had lots of gold obligations to pay. And this was a terrible shame on the US Treasury, because the first time, practically for the first time in history, the US was about to default on its foreign gold obligations. And to cover that up, the central banks of the world got together and they declared that there will be a two-tier gold market. What this meant was that there will be a so-called free gold market where the price of gold would vary with supply and demand, and there would be a practically hermetically separated other gold market for the official holders of gold, meaning central banks and treasuries, and they would stick to the price of $35 per ounce, which had been continuously maintained ever since President Roosevelt dreamed up the gold price. That's literally true. There was no study, nothing. He just got up in the morning and he was still in bed, and the Secretary of Treasury and Federal Reserve, etc., were there in the bedroom and said, 35 is the number. Previously, the gold price was about $20 an ounce, so they raised the gold price to 35, and that had been in effect all the way for more than 30 years, to be precise, 34 years. And then the US was at the point of defaulting because they were scraping the bottom of the barrel. There was practically no gold, but all these claims on the US gold, because all foreign central bank holdings of short-term US obligations were supposed to be convertible on demand into gold at that fixed price, but there was no way to carry on any further. So they came up with a phantom, a farce, in fact. They pretended that there were two markets. One is the so-called free market, and the other is the official market, where they were continuing to buy and sell gold at $35 an ounce. And of course, this was a default, pure and simple. There's no two ways to describe it. It was just a default of the United States government on its foreign gold obligations. But you had to hide that fact. You had to dress it up and have a fairy tale surrounding it that, oh, well, there are two gold markets, two-tier. The official tier, which sounds very convincing that this is a sound tier, and the wobbly other tier, the free market for gold. So just confusing the world opinion, public opinion. They did not want to spell it out in black and white, that this is a default, and you better take the consequences. So the universities weren't allowed to study the problem, financial journalists weren't allowed. So there it was, and what is happening today is a kind of a repetition. History is repeating itself. And I was going to explain it in a little more details, but
you'll go through the question group.
Okay. So, yeah, sure. There was a problem here. You see, NASOA, our organization, New Austrian School of Economics, has been studying gold backwardation for more than 10 years. And we were the leaders. In fact, we were the only ones in the early days, and we forced the others to take notice that here is a problem. The problem was this. Did you mention gold bases? Mm-hmm. Yeah, okay. So the gold bases, I'm sorry, bases in general.
Not in general, no.
So bases in general is
it's just the difference, yeah.
This is the difference between, let's talk about wheat, but that's just one example. All the other commodities have the same. Wheat for nearby future delivery has a price, and wheat for delivery on the spot right now and here has another price, and you take the difference of the two prices. And this number is a very important indicator, and it's called the basis. And all future markets produce this number because they have a nearby contract which is going to mature first, and it has a price. And of course, there is the cash market where any payment is for delivery on the spot right now. Okay, so the basis for agricultural commodity shows a very clear cyclical pattern. What happens is that it follows the warehouse stocks. If the warehouse stocks are high, then it's going to be contango, which means there's a healthy premium on the future contract, nearby future contract. Now, when the warehouse stocks are low, that's a clear indication of the opposite, that there are shortages. The warehouse stocks are not satisfactory for the existing, to satisfy the existing demand. And as a result, the cash price goes to a premium relative to the nearby future price. And that is an indicator that cannot be falsified. The gold price can be falsified, the interest rate can be falsified, and they do. All the governments are in business of falsifying all the important indications, but the one indicator they cannot falsify is the basis. And the fact, especially when it goes negative basis means backwardation. All right, now going back to the agricultural commodities such as wheat and soybeans and all the rest of them, what happens is that at harvest time, or just before harvest time, the basis goes negative, indicating that you are scraping the bottom of the barrel. There's very little in the warehouses because they have used up during the crop year all the supplies, and now they are anxiously waiting the new harvest to come in and go to the warehouses, which in the case of wheat, for example, they have the grain elevators, and corn, when the harvest is brought in, then the farmers send their surpluses to the elevators, and that's where it is being held. So that is the low point in that cyclical cycle for the basis, and then the crop comes in, all the warehouses are filled, elevators are filled, and then it takes the crop year to bring down the supplies, and then the cycle starts all over again when the following year's crop is about to be harvested and brought in. So that's unmistakable. This is what happens. Now, you must remember that there were no gold future markets before 1960 something. There were silver, because silver was traded in the futures. But as far as gold is concerned, it was an unknown what will happen, and in particular what will happen to the basis. As it turned out, when gold futures trading started first in Canada and then after 1975 also in the United States, then it turned out that the gold futures market had a robust contango, which meant that a very healthy premium existed for the futures, all the distant futures, but also for the nearby. And it changed with time, but then nobody actually saw a clear trend. It was, of course, conjectured that there will be no cyclical, because there is no harvest. I mean, the gold mines don't operate like a farm, that there is a definite date for the harvest, and then the crop year when they bring down the supplies. So people accepted the fact that there's no point looking for a cyclical pattern for the basis. There's no reason to expect anything like that. However, it was not recognized that there was still a kind of regularity. We are way back in 1970, around that. And in particular, the clear trend which was formed, and it took decades for people to realize what was going on, that there was a falling tendency for the basis. Started out from the maximum, which is known as the carrying charge. I'm not going to go into the explanation why, but that's the top. The basis cannot be higher, positive, but cannot be higher than this maximum called carrying charge. And then, year after year after year, there was a definite tendency of a falling basis. And it took decades to recognize this, and then they tried, a few people tried to explain this, and they couldn't. And that's when I myself became interested in the problem, and I came up with the conclusion, which was not echoed by the financial journals or any analyst who was studying the problem the way as I was. They didn't come up with the same conclusion, but I suggested that this falling basis is like the result of gravitation. The falling basis reflects the available, deliverable supply of gold to the market. And very, very unobtrusively, this basis betrayed the truth, the underlying truth, that there is less and less and less gold available for investment purposes, for jewelry, for dental applications, whatever. And it wasn't the price which suggested that, it was the basis. So there was a big shift. The price, the gold price, was for the birds. I mean, no serious scientist or analyst would give any credence to the gold price, which was manipulated on the one hand. On the other hand, it was very sensitive to all kinds of political events, quite unrelated to the gold market. For instance, if war broke out, the gold price shot up. There is, yes.
Sorry. Could you give an example of how gold price was manipulated?
Could you give an example of how gold price was manipulated?
Oh, that's a subject in itself. It would lead too far away. Let's just say this, that all markets are manipulated. But if you ask the question, which market is most manipulated, then the clear answer is the gold market. And why? Because the governments consider the gold price as an indicator of their
ineffectiveness.
Chicanery. They are cheating. They are, for instance, Roosevelt called in all the gold from the United States. Citizens had to surrender the gold. And then, no sooner than this was completed, he put up the gold price from 20 to 35, but made sure that the government would have the gold, you see. So, I mean, the worst kind of cheating happened in the gold market. They happened in other markets, but the gold market and of course they could do that because the central banks had very large gold reserves as a leftover from the gold standard days. And they could threaten, they didn't even have to sell the gold, they could just drop a hint that the US Treasury is considering reducing its, so there will be periodic auctioning off US Treasury gold. Same with IMF, the International Monetary Fund had a huge, perhaps the second largest gold hoard in history after the US, and they were auctioning off part of that, but sometimes they didn't even have to auction it off, just threaten, just put out a communique that the IMF is considering, and of course they dressed it up, they said they need to raise money to help the developing country. See how nice they are, selling gold. But very little gold was actually sold. It was a psychological warfare. But that's a big subject, and I don't know.
I appreciated it. I was more interested actually in how is gold market manipulated on a daily basis now. That's what I'm kind of really interested in.
All right, so
I can tell you a lot more about.
I'll have a chat with you later.
So I called attention to this phenomenon that the gold basis is declining, and the gold basis is incorruptible. The gold price is not incorruptible. It is highly corruptible, but the gold basis is not, and therefore it has a message, and the message is there to be deciphered. It's a coded message, and you want to understand. So, well, of course, we didn't know the clear answer. It was just something to watch, and ultimately the gold basis fell to zero, not along a straight line, but with zigzags. And then the question was, what is going to happen now? And of course, we who were not committed to any kind of government propaganda, we said, yes, it's going to be negative, and it's going to be jumping in and out of negative territory, go back to positive, and so on. But ultimately, it's going to be permanently negative, and that's what we call permanent gold backwardation, which indicates that now there's so little deliverable gold in the gold market that those who have commitments to deliver gold at some future date are going to be in trouble, and they ultimately have to default. And then we had to study the consequences, and the consequences were terrifying, because what it means, permanent gold backwardation, is that gold is no longer available at any price. You could bid up the price of gold, but there'll be no offers. The offers will disappear from the board. Nobody, after a period of time, nobody will be selling gold. In other words, if you want gold, you have to go to barter. You have to sell paper is no good. You won't get any gold for paper. But if you have silver, you can barter. If you have crude oil you can barter for gold. If you have wheat or any kind of food stuff which is in short supply, you can barter. So in other words, the bottom line is that from multilateral trade, the world is reduced to barter, which is a retrogressive step. You know we owe our prosperity to multilateral trade. That it doesn't really matter what you are producing as long as it's a useful good, then you can get, well, we have been through yesterday this, you can get anything, because the money, if it's good money, will make it possible to make the exchange through the intermediary of money as the most marketable good. So that is fading out. Now, the problem is that this is highly contagious. For gold and silver is going to be barter first. But then the contagion goes on and it spreads to other highly marketable commodities, such as I mentioned, crude oil, corn, and other metals, base metals, which are considered highly marketable. So that is a conjecture, because it hasn't happened yet, and in all history there's no precedent for this. But we were very confident and announced this, that this is in the future. And the consequences are very, very grave, because it means that there will be shortages all across the board, there will be bankruptcies, there will be unemployment at an unprecedentedly high rate, and even pestilence, breakdown of law and order, and you just continue the list. All kinds of catastrophes will hit the world, and hit the world indiscriminately. It's not necessarily the guilty countries which will be punished, but the whole world, and there is no escape, practically. You have to jump off the globe in order to escape. So there it is. This is the picture, and it's just a conjecture, just a warning that this is what we are facing unless we coax the gold out of hiding. Because what has been happening was that gold didn't disappear. Gold is pretty well indestructible, but it went into hiding. And that's exactly the same what happened in the last days of the Western Roman Empire, which collapsed in the year 476. And after that, the Dark Ages followed, where there was no security, no public security. There was roaming bands of armed people, and they robbed indiscriminately everybody on the highways and off the highways, and so on, and lasted hundreds of years until, of course, we know that eventually the world came out of it. Basically, again, for commercial reasons, because the Italian city-states introduced bills of exchange, and that helped to coax gold out of hiding. But this is something to remember, that the return to barter, it goes hand in hand with pretty well the collapse of civilization as we know it. And therefore the governments should really take care that this doesn't happen. The world should not be allowed to fall back into barter, because especially in our case, when our very highly developed trade and industry, and just think of the computers and jetliners and all other things which didn't exist in the past, are very highly vulnerable for a trade, world trade, where things are available. If there are breakdowns and so on, then the whole thing could collapse like a house of cards. And so we are on record to predict this, that unless the governments wake up and do something which will reboost confidence, that gold will come out of hiding and so on. And they could do that overnight by opening their mint to gold and silver. And they are not doing, they are not even considering it. No political party. And you know, we are pretty well in the minority of one that this is going to end in a very sad way. Now, what happened was, starting in 2008, gold showed like going into permanent backwardation. So, of course, we were very curious to follow the events because our reputation was at stake. We predicted this Armageddon, this cataclysmic collapse of world trade, unemployment, and all the rest of it. And, well, is it happening? And that was 5 years ago, and nothing like that happened. Of course, things got worse and worse if you followed the real indicators, not the government manipulated indicators, rate of inflation, unemployment, and all the rest. But nothing like what we have been predicting. So the question arose, well, is the theory wrong, the theory what we have been advocating, or is it that what we see is not really a permanent backwardation, but just a warning, and it will go back and forth, and so on. So there was no clear-cut answer, and I am very proud to commend Sandeep here, sitting next to me, who came up with an explanation which I myself found acceptable and found as the most likely explanation. And what Sandeep did was he drew a parallel between the two-tier gold market of the 1970s and the present, what you could call the two-tier gold backwardation. Now, I have already explained the two-tier gold markets in the 1970s, which ended in an utmost failure, a shameful thing, because the official gold market was a sham, it was a farce. No central bank was willing to sell gold at $35 when they could get $70 in the other tier, the free market. And so this was just maintained to fool the people around the world, this two-tier. It was a farce. And what Sandeep suggested, and perhaps he could explain it better than I, that the two tiers today are the gold future markets on the one hand and the gold lease market on the other. And the thing to watch in the gold future is the gold basis, and the backwardation, meaning that the gold basis goes negative and gets stuck there, never again to come out, which hasn't happened yet. And the other tier is the gold lease market, where the corresponding indicator is not called the basis, it's called GOFO. But I'll leave it to him to explain GOFO. We tell the audience what it means. It's gold
Offered forward rate.
Forward rate. Technical, but you will have to wait a little bit for the explanation what it means. So these are two indicators, and one is a sham and the other is the real stuff. You know, just like the way back in the 1970s, the phantom price of $35 an ounce, which the governments wanted to maintain, didn't work, but they still maintained this. And then, of course, the more information came out of the free market price of gold. So the gold lease market is, in my opinion, and I think Sandeep would confirm that, is a farce. It's a phantom market because leased gold, which means bottled gold, really. I mean, there's no need for another word, but they came up with that, so we are sticking with the leased gold cannot do what cash gold, fully owned gold can do, which means extinguish debt. It's the only thing. Now, if you lease gold for any length of time, it has to be returned. So how can you use it to extinguish debt? It's a crazy idea, but that's what they pretend. That the lease market, the gold lease market, is solving all our problems because the debt can ultimately be reduced. So that's what I wanted to say, and we can continue with the discussion.
I was going to say we'll have a 10-minute break, and
okay.
Then unless there are any immediate questions right now that you might forget if you wait 10 minutes. Okay, we'll come back in 10 minutes. So.